Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Just wiping my head there. I'm Ira Epstein, and here we are on Tuesday, October 25th, 2011, getting on to be 2:50 in the afternoon. And as you can see, you're in the midst of a stock market sell-off, not a crash, an orderly sell-off. At the same time, you're getting a bid into the bond and the note market. We had bad U.S. economic data today. Consumer confidence down sharper than most people thought. I'm watching retail sales and some of the other numbers, and we have a very mixed bag. Gold got bid up today, up $50. Silver up $1.57. And copper, well, copper's made its move. It's ready to digest what it's just done and maybe consolidate a little bit, in my opinion. The big moves are going to come out of the euro, which isn't going much of anywhere today, and the dollar. I think that what you're caught is looking at the news of the day. And as you know already, the news of the day, if you were watching the financial news networks of any type, you saw that one set of meetings was canceled by the EU, and now they're going to have another set. They're still saying they're coming out with an announcement tomorrow, but what does that mean? I have been writing that my guess on the market is going to be they're going to announce a plan for a plan. I know it sounds confusing, but that's still what I think. I don't really believe they're going to come out tomorrow and say, okay, we're going to leverage this funds. We're going to put up 2 trillion euros in this way. We're going to go out and we're haircutting the European debt, the Greek debt specifically, 60% or 50% and give you all that. I think it's a plan of a plan they're going to announce, and it's got to get done fairly fast. The market is demanding it. So the market might have a little disappointment, and I think that's what's happening today from hearing that that's not completely all agreed to. But then the market has to digest and figure out, well, if they're going to do something, how disappointed should we get? Maybe, okay, we're not going to get it tomorrow, but they say they're going to get it done in X period of time. This is the confusion, and it's very hard to call. The interesting thing about gold, before I go into the charts, is in the past when we've seen the stock market crash or people just plain got scared, they dumped everything to raise cash. Today they didn't quite do that. They were buyers of gold and copper, or somebody was. They drove prices rather smartly higher, and you see that on this chart of December gold. In fact, let me blow it up for you so you can see it even better. And what we've done is we've come out and we're near the top part of this whole trading range that the market's been working on. Remember, I've been telling you that I think markets work in stepping ladder impacts. And I think that what we saw is between, I guess you could say 1703 and the 1920 area, the market had one ladder. It came down, found another plateau to work from, and the word is down into that 1535 and now back to 1705 area, right in that general zone. So this is that other plateau, and the question is, does the market have it within it? Does it get the reason to step back up into this resistance area now? The number I've been telling you to look at, and I think I've been consistent as can be, and I know I have in my writing since July, is that I'd look at the close of July's price, which was 1621.70, and I believe the market will end up the year higher than that number. So the question is, how do you play against it? And if you draw that number on here, I don't think you'd argue with me that so far it's been a pretty good number or a line in the sand. But today something happened that's good. You've gotten over the most recent highs. The pattern is one of a higher high, so the next break low is super important for the market. It should not take out 1604.70 if this trend is going to lift and have more to it. The 18-day average of closes is lifting up, and it's at 1654.10. It's about $50 away, but look at how the market came into that general zone. And if you remember, I've been talking to you about the 100-day and the 18-day average of closes. This is the 45-day. And I said that if you look at it, this market's been fighting a battle, and this is as of Monday. It's yesterday's close. And I've been saying, look at how the market recently has just been fighting against that. I don't know which way it's going to break out. If you get my twice daily updates, I wrote that I said if you can take out 1666.90, maybe the market makes a run for the closest of, now get ready, the 45-day average of closes only because it's the highest moving average I use that's above the market, or, and let me just put this on the chart and bring you up to date, or the Bollinger Band. And lo and behold, it became the Bollinger Band today. So as far as I'm concerned, the market has completed its first wave to the upside. And one of the things I teach in my charting course, which will be ready in about a week to release now, I believe I've completed it. My own crew here is going to go through the whole course now, but it's lots of work all summer, and it's done again. It's my 5th revision of it over, I don't know, an 8-10 year period. It's quite a while. But take a look. You hit that. I don't teach to buy a Bollinger Band, as I don't teach to sell into a Bollinger Band. I think the market gives you a chance to work out. Now, Bollinger Bands, when they narrow in, tend to find a reason either to stay narrowed in or then to widen out. Well, this market's come all the way down. It's developed some nice sideways action, which has gotten it to a more reasonable status. But even that status tells me don't chase over a Bollinger Band. If it wants to break out, fine, but I'm not betting that it will. This is the first zone today where the resistance should be encountered. When I add momentum to it, you can see you're just getting into an overbought status. You have your red line reading of 70.47. So every reason is out there. If one or long, take some of the money off the table and see what the European situation turns out to be. And before I go to silver, I want to remind you of my webinars behind me. All I've done is put up what I typically record. And the charts will look like this. They're going to have Bollinger Bands, the moving averages that I talk about, but then they'll have window envelopes. They're going to have more studies than I do here. And imagine me talking over this, and I'm walking you right through what I think is a buy and a sell condition. And I do it in what we call our recorded webinars that are not seen here on the Internet. They are not available to the public. You get free access if you haven't tried it before by calling 1-866-973-2077. That's our number here. Just tell them you want to get access. You haven't had it before. This is a normal $50 subscription for 30 days. It's yours to try for 2 weeks. Absolutely free. And what do you do for it? Nothing. It's a phone call. Can't do that? The heck with it. So let's look at silver. Does it look a lot different than gold? It doesn't. But this is too narrow. If you take a look back here, I've kept the scales very similar. This is one of the narrower Bollinger Bands, and we're going to see what that ends up meaning. But can you imagine that this is a bottle of wine that you put on your stove and it melted, flattened itself down? Now all that pressure from here is going to push in, and as it does, the market, one way or the other, is going to relieve the pressure. Right now, the bias is to the upside, but if you were long, you're at the Bollinger top, you're overbought, guess what I would tell you? Gee, take some money off the table, let tomorrow occur, and then take another look at the market. This is the gold-silver ratio, and the last time I showed this to you, and I'm going to really carry this back, was over here. Right about here. And this market was stuck, and if you go back to my other videos that are available for you to watch, you'll see I was talking here. I said, I don't know which way it's going to break out. This market went all the way back up. And this is the amazing thing. And by the way, it does pay attention to Bollinger Bands. And look where the market is trading against. I'm going to just bring you up to date right now. This is today. That 18-day average and back under it. So silver has gotten a little stronger than gold. But what's going to happen in my prediction, doesn't mean I'm right, is that you're going to develop this neck a little longer. This is more normal relationship of the market. When you get this wide out, and that just happened recently from September to October, it's when investors started at least not breaking gold anymore, but they kept breaking silver. You needed more silver to buy gold. We've just seen that ratio actually in the 32, 33 to 1 area. Right here, it's still in the 40s, and now it's just gotten too high at 54. So there's a norm it's going to reach, and we have to wait and see where that's going to be. But at this point in time, the market does favor the silver over the gold for whatever reason. In the copper market, think of yesterday when the market got up, and I'm telling you, anything against the Bollinger Band, I don't want you to be in. Market hits it right back down. Perfect. This is why I'm saying in the gold and the silver markets, I'm fearful. Okay, I don't like buying Bollinger Bands. And when I say I don't like recommending it. I don't teach it in my course. That's my definition. Wait for the market to pull back. And if it doesn't pull back, wait for another opportunity, a better chart pattern. You're overbought. Maybe you'll go back to that 18-day average of closes, and while the pattern is one of a higher high, you have to confirm somewhere along here that the next break doesn't take out that break low. And with the European situation the way it is, why take the gamble? Here's the dollar index. You have an embedded stochastic, which is bearish. The chart pattern is one of lower lows, but not necessarily lower highs. I'd like to see this rally fail and then start down again to know that the market's staying down. Otherwise, what I'm fearful of is you just fell back into a previous trading zone and you have to wait and see the action. Given that tomorrow's so nutty with what may or may not happen, why put yourself in harm's way? It just doesn't make sense. This is sugar. I just happen to like the chart pattern as long as 2648 is not taken out, that the market still has upside bias to it. And this is a ratio, the difference of crude oil, WTI, versus Brent, the world grade. All of a sudden, look what's happening. These spreads are coming together. So the prices are getting closer, and Cushing has been seeing what we call, that's Oklahoma, by the way, American oil, get some backwardation. For whatever reason, it's starting to get very bullish in America on crude oil prices. With that, I'm Ira Epstein. I hope you give us a call for our webinar. You're going to see me later this afternoon, Barry Rosen of FortuCast, and I'll talk to you all tomorrow.